If you think Canada's real estate market is crashing, you're missing the real story. If you think it's about to explode again, you're missing it too. The truth is far more interesting. Behind every headline about falling sales, rising rents, or retency buyers, three powerful forces are quietly reshaping Canadian real estate from the ground up: supply, affordability, and investor focus. These forces don't move overnight, but when they shift, they redefine who wins, who waits, and who gets left behind. This isn't just about prices. It's about power. Who has it, who's losing it, and where the smart money is moving next. Let's break down the real drivers shaping the Canadian housing market right now. 1. Supply. The shortage that won't go away. Canada doesn't have a housing cycle problem. It has a housing supply problem. For years, population growth has outpaced construction. Immigration targets remain high. Household formation continues. And yet new housing completions simply aren't keeping up. Even when demand cools due to interest rates, the underlying shortage doesn't disappear. It just hides. Why supply is so tight: zoning restrictions limit density in major cities, construction costs remain elevated. Labor shortages slow down projects, approval delays stretch timelines by years. In theory, higher prices should trigger more building. In reality, developers face thinner margins, tighter financing, and higher risk. Many projects are paused, not cancelled, which means fewer homes today and even fewer tomorrow. This creates a paradox. Sales slow down, but prices don't fall dramatically. That's why even cooling markets still feel unaffordable. 2. Affordability. The real crisis isn't price. It's payments. Most buyers don't care about sticker prices. They care about monthly payments. Affordability in Canada has been crushed not just by home values, but by interest rates, stress tests, and rising living costs. Even when prices soften, higher borrowing costs can cancel out any benefit. For first-time buyers, the challenge isn't saving for a down payment anymore. It's qualifying at all. What's driving the affordability? Squeeze mortgage stress tests, reduce buying power. Higher rates increase monthly payments. Rents rise faster than wages. Inflation eats disposable income. This has created a market split. Buyers with equity can still move. First-time buyers are locked out or delayed. Renters stay, renters longer than planned. Affordability isn't improving fast, but even small rate cuts can have outsized psychological impact. When buyers believe affordability is improving, activity returns quickly. 3. Investor focus. Smart money has changed strategy. The biggest shift in Canadian real estate isn't among buyers, it's among investors. The era of fast flips and speculative condos is fading. Investors today are playing a longer, smarter game, focused on cash flow, resilience, and fundamentals, where investors are moving purpose-built rental housing, multifamily properties, industrial and logistics spaces, secondary cities with population growth. Investors are no longer betting on appreciation alone. They're betting on housing necessity. Canadians may delay buying, but they can't stop needing a place to live. That's why rental demand remains strong, even in slower markets, and why institutional money continues flowing into residential income properties. 4. The rent trap. When ownership delays fuel demand, as buying becomes harder, renting becomes permanent for more households. This creates a feedback loop. Fewer buyers gives more renters gives higher rents gives harder to save gives delayed ownership. This isn't accidental, it's structural. For investors, this is opportunity. For governments, it's a warning. And for everyday Canadians, it's a reality check that the market isn't resetting, it's reorganizing. 5. Regional shifts. Canada is no longer one market. One of the biggest myths in real estate is that Canada moves as one. It, do, is, in. High-priced metros like Toronto and Vancouver face affordability ceilings. Meanwhile, secondary markets benefit from migration, remote work, and relative value. Cities with job growth, infrastructure, investment, lifestyle appeal, lower entry costs are quietly outperforming. The result, a more fragmented market where local fundamentals matter more than national headlines. 6. What this means for buyers, sellers, and investors. For buyers, patience pays, but paralysis doesn't. Markets reward preparedness, not prediction. Those who understand affordability cycles will move before competition returns. For sellers, Pricing matters more than ever. The market no longer forgives overconfidence. Homes that are priced right still sell, others sit. For investors, cash flow is king. Appreciation is a bonus, not a guarantee. The smartest investors are buying sustainability, not speculation. The market is choosing, not crashing. Canadian real estate isn't collapsing. It's selecting. It's selecting patience over panic, fundamentals over hype, long-term thinkers over short-term gamblers. Supply will remain tight. Affordability will move slowly. Investors will continue adapting. And in that quiet shift, the next cycle is already being built. The question isn't whether the market will change. It already has. The real question is simple. Will you understand it before everyone else does?